Hello, good afternoon. You're tuned into MF Corner on CNBC-TV18. I'm Vinny Motiwala. With me is my colleague Sonal Gutra as well. Sonal, good afternoon. And we always want to break down everything for our viewers, but this is something that is very important because when I started investing, I used to be confused between the difference of these two, that is regular and direct mutual funds, right?
So exactly that's what we are going to break down for our viewers today and touch upon the basics of mutual funds for the benefit of our viewers as well. What are the differences between regular and direct mutual fund plans? How different plans impact investors' return? Whether a first-time investor should go with direct or they should stick to regular? What is the cost-benefit analysis? To understand this and more, we have with us Santosh Joseph, founder and partner at Germinate Investor Services, and we'll have Sandipan Roy, CIO at Motilal Oswal Private Wealth, also joining us in just a bit. Santosh, good afternoon. Thank you so much for joining in. Most new investors hear the terms direct and regular, but the conversation often stops at direct is cheaper. That's something that everyone just talks about. Beyond cost, what are some of the other factors that an investor should consider before choosing one over the other?
Hi, good afternoon to both of you. Good to be back. And I agree, this is a hot subject and many people want to know, and I'm sure many of the viewers also would like to know a simple answer whether direct is cheaper. Now, while that's a term that's getting popular, I think the beauty lies in the detail. Now, the minute you realize that direct is cheaper, and then you realize, what am I getting if it's not direct? The whole characteristic feature that you get in going for a full-blown service that is in the regular plan is that you got someone to help you through this entire journey, help you navigate. To begin with, the process of determining value is just beyond the cost of the fund itself. How do you determine value? You determine value by how you are able to select the fund, how you're able to do asset allocation, how someone is able to handhold you, guide you, what to select and what not to select. Sometimes we miss the most important thing, that if an advisor or a distributor helps you stay away from meddling with your own portfolio, that is not to redeem when the times don't look good, or to let your funds stay the course, or not to unnecessarily tweak or churn or change your portfolio. Now, these things are not priced in, not quantified, not validated. Therefore, it looks like that direct is cheaper, and without being able to put an intrinsic value to guidance, intrinsic value to asset allocation, even allocation of your monies to the goals that you have, that is aligning your money to the goals, is a very critical part of your journey towards building wealth actually and keeping wealth.
Absolutely. Thank you so much for that, Santosh, and thanks so much for joining in. We also have Sandipan Roy now with us in the conversation as well. Sandipan, good afternoon. Thank you so much for joining us. And obviously, firstly, I'll take that first question with you as well. In terms of, obviously, when you look at it, it often stops at direct being cheaper. But what is the benefit beyond that for investors in terms of direct mutual funds or in terms of regular mutual funds? What are the factors that one should consider, if you would like to add anything to that? And overall, for someone who is investing for a long term, say 10 to 15 years, how can the difference in terms of return be between regular as well as direct in terms of cost difference also comes in?
Right. So let me take the last question first. In terms of the cost difference, if we assume there's an 80 basis points kind of cost difference between a direct plan and then regular plan, then it will be around, let's say, 20%, assuming a 12% kind of gross return over a period of 10 years, okay, which is substantial. Your 1 crore, let's say, goes to 2 crores, or it goes to 2.2 crores, right? So, or 2.4 crores rather. Okay, so that differential is substantial, but you also have to understand the other aspect, which is that of taxation. So let's say you are holding a regular mutual fund, regular code mutual fund today, and now you want to switch to a direct code mutual fund. But that will have a tax implication, right? You will have to pay, depending on the holding period, either a short-term capital gains or a long-term capital gains. So either it will be 12.5 plus sales plus charge surcharge, or a 20% plus sales plus surcharge. Now that, let's say, assume it's a long-term capital gain, so it's about 15%. So that cost, when you add to it, the break-even happens almost in about 8 years or so. So you have to be very sure that the mutual fund that you are investing in today, after doing the switch from regular to direct, you are going to hold on to it for at least the next 9-10 years. only then will the benefits accrue to you. Because today when you are redeeming or you are doing the switch, please remember it's a redemption plus buy plus an investment.
Okay, all right. This is a question to both of you, but let me start with Santosh first, because advisory comes with value, whether it is behavioral guidance, asset allocation, we talk about rebalancing as well. Is it possible for an investor to quantify that value when deciding between the two options? Because while we can quantify the other part in terms of cost, what about these factors?
I think you rightly said that the most important value is not saving on the expense ratio. What we are able to see here is the difference that I'm saving between regular and direct. What we are not able to see is the value that the advisor brings to the table in handholding the client. And let's take a small example. If the client got worried in the last 1 year or 2 year or 3 year because of markets or valuations or just the way the markets have been sideways, one would exit or one would not invest in the markets. This is where the advisor alpha or the advisor role in generating wealth, apart from costs, come into play, which will just cover up the cost and you won't even know there was a cost. Coming to your previous question, on a 10-year, 15-year, 20-year basis, yes, there will be maybe a 1 or 1.5% extra CAGR return that you will make in a direct plan. But don't forget, you will miss out a lot more by not having the right guidance, the right handholding. Sometimes we forget that loss aversion or reducing the risk itself is huge returns, and it doesn't even compare to the costs.
Absolutely. Sandipan, the same question to you. How do you see in terms of an investor, how should one quantify the value that comes in deciding between both these? And also, sometimes you often hear that argument that experienced investors should go for direct and beginners should choose regular. Do you agree with that, or is that a decision more complex than it just sounds like, oh, you can just pick this?
Let me, ask a question. Why does Roger Federer have a coach, or a Novak Djokovic, he has a coach, right? Why does the Indian cricket team has a coach? And more often than not, the coach is less skilled than the person who is coaching, right? Because that brings a very important perspective, which is a holistic perspective. Where you are going wrong, is he dispassionate? Because he's detached from you. So he's having a far more, I would say, top view of your performance, of your situation than you can have when you are completely in the situation yourself, right? So that's one. And on the mutual fund, advisory side or direct quote side, why you need an advisor also is not just to do the fund selection. You also need a advisor to do the first step with the first principles. First principles is that of asset allocation and your strategic plan. What is the investment objective you're trying to achieve through this investment goal of yours or through this investment plan of yours? That entire thing, more often than not, you need guidance, you need handholding. And as numerous studies have showed that asset allocation is the biggest guiding principle on the returns that you get, and not the instruments that you pick, right, at the end of the day. So if that is the case, then your journey starts from defining your investment objectives, basis your current situation and where you want to be. And that, I think, you need an expert advice on, right? So that's the first step. And then comes the second step where I'm doing a fund selection. We are tracking them. And in today's world, obviously you are aware, there are so many changes happening even in the mutual fund space, right? Fund managers who have been in the same fund house for 10 years, 15 years, suddenly are shifting out, right? Either they're moving to another mutual fund or they're starting on their own. So how does an investor, an ordinary investor, keep a tab on all those things? And a fund at the end of the day is as good as the fund manager who's managing it, right? It's his own personality stamp, and especially if he's managing it for the last 5 years, 10 years or so. So there, you need advisors who can at least guide you, keep you updated, help you with all the information asymmetry that is there in this entire vast space.
Okay.
Apart from the financial planning.
Okay. Yeah. Sandipan, if you can quickly tell us, if somebody is already invested in regular plans, when does it make sense to switch to direct? And also, what are the implications in terms of tax costs if they do so?
Yeah. So as I said that if I have to give the main clause here, it's that whenever you are switching, again to repeat, it's a capital gains incidence for you. So you should be very, very clear that when you are switching or making that shift from a regular code to a direct code, you should be in that fund for the very long haul. Otherwise, the break even doesn't happen. When you have a with surcharge, let's say a 15% tax incidence, to recover that 15%, you need to be with a 80 basis points or a 1% expense ratio differential. You need to be in the fund for the next 8 years. So that discipline, that that clear clarity of thought has to be there. Okay, but if it's an incremental investment and you are a very savvy investor who is completely hooked to the market, who knows what he is doing, then you can do direct. But if you are, if you are still in the first steps where your financial plan needs to be done, your investment objectives need to be set, your risk appetite, your disposition towards risk needs to be assessed, then it's always better to go through an advisor through the and not DIY.
Absolutely. Sandeepan as well as Santosh, thanks for the views coming in on a regular versus direct funds, how one should go about it as well, and when one should look to switch. But do wait on with us because we're going to slip into a very short break. On the other side, we want to put the spotlight on matrices and metrics that such as absolute returns, CAGR, XIRR with our guests. So we'll continue that conversation. Do stay tuned.
Welcome back. You're still tuned into MF Corner. We still have with us Santosh Joseph of Germinate Investor Services and Sandipan Roy of Motilal Oswal Private Wealth. Let's now understand some important metrics such as XIRR, absolute returns, CAGR as well for our viewers, because we keep seeing these numbers, but sometimes it's so difficult to comprehend when to look them, what to make of them when you are doing your portfolio review. Sandipan, let me start with you. Let's make it very simple. How do you differentiate between the three in an easy way for our investors when they are doing maybe SIPs or lump sum investments? Tell that to us.
Yeah. So let's take a quick example because that will help to decode. Let's say you have put in 1 lakh rupees. In 3 years' time, it becomes 2 lakhs. So you've doubled your money. That's the absolute return, right? That from one point to the other, you put in 1 lakh, it became 2 lakhs. So you have gained 100%, right? If I have to look at CAGR, then it becomes 1 lakh to 2 lakhs in 3 years, about 25% CAGR, which means compounded annual growth rate is 25%. So which means you put in 1 lakh and then it grows every year by 25%, then it becomes 2 lakhs in 3 years' time. Okay, that's like giving you an annual rate. And now if I have to do XIRR, things become slightly more complicated. We never do a lump sum investment of 1 lakh. Let's say we are an SIP guy. So we will be doing, 5,000 rupees per month kind of investment. And that then, over a period of time gives you the 2 lakhs. So instead of 1 lakh as lump sum, we have been doing an SIP. And that SIP has over the next 3 years given you a return of 3 lakhs or 2 lakhs. So that return will be slightly lower than the other two returns. And this will be XIRR because, see, even I am not able to manually calculate it. When I'm saying I'm doing 5,000 rupees per month SIP for the next 2 years, and hence I got, let's say, 2 lakh rupees when I invested 1,20,000, it becomes very difficult for me to do an actual rate calculation there. Probably it is 15-16%. Okay, but that's the XIRR calculation that comes into play, where your cash flows are taken into account, the time of your investment is taken into account, and any cash flow in or cash flow out is also taken into account.
Absolutely. Santosh, in all this, many people normally only look at absolute return and assume their portfolio has performed well or poorly on the base of that. Why can that be misleading, especially for a long-term investor on SIP-based investments that come in?
Well, as Sandeep very clearly explained, the absolute return is an absolute point-to-point, the amount of money you put and the value of the money it is today. The first things first that you miss out in absolute return is the time value of money, that how much time has it taken for the money to grow, and whatever money that you've grown, what does it mean over time? It ignores that. The second thing is that even though your absolute return may look big and bulky, but the minute the number of years are more, the returns drop. So absolute returns are good to give you just a macro point to point, but it fails in taking into account the time spent and the periodicity of the investments that have happened. And especially in a volatile market, absolute returns will also be misleading you to show you lower return than what it is, because when you're investing, especially in an SIP or even in a non-structured format with infrequent investments, your every investment get treated as a new investment, factoring for amount, the date of entry, and even for the time spent. Therefore, absolute falls short. You will have to move to either CAGR or XIRR to give you a better sense over time for the money invested.
Take that point. So XIRR is when you do not have steady flows or a lump sum flow. You are doing it at intervals, so it does take into account the time value of money as well to count your returns. Sandipan, there are online calculators and platforms showing these metrics, but how can an investor know whether the number they are seeing is calculated correctly, especially for irregular cash flows?
Yeah. No, so there I think you need to also do some hard work. Because XIRR needs to be calculated in an Excel, otherwise it's very difficult to compute manually, or intuitively. So do one simple exercise. At least take one entire cash flow of yours, put them all in an Excel where your inflows, put them as negative numbers. Let's say every month you are putting in 5,000 rupees. So put it as minus 5,000 and put the dates on the right column, and then when you are getting the final value as of today, let's say it's 200,000 or 2 lakhs, then put that as a positive value at the end and calculate the XIRR. It's a simple Excel XIRR function. So what you get, see whether it is the same as what the website is showing. More often than not, today's websites are automated. They will show you the right returns, but you should verify it also. If the calculations are more or less plus minus 1%, you are there. So it should be able to rely to that website for calculations.
Okay. Santosh, just a quick one. In terms of if an investor is reviewing their portfolio once or twice a year, what's the right framework or checklist maybe that one could have for evaluating returns meaningfully without getting lost in terms of the numbers there?
See, the numbers and the jargons can intimidate an investor, and let's also remember sometimes if they're doing it on their own, they'll be wondering, okay, now I'm doing my investments on my own, am I really making the money? The first things first, have a look at whether your fund is beating the benchmark. The second thing is, are you actually using the right measure? For example, many people, they will be in a multi-cap fund or maybe in a mid or small cap fund, but they'll be comparing their performance to Nifty. So you have to also compare apples to apples in this context. And the third and the most important concept is that you have to ensure that the returns that you are expecting to the return of the peer group of the fund. For example, if you are in a flexi cap fund or a mid cap fund, you want to check how am I faring against the broader market, which is the right market, a real comparison versus the peer group in that segment. So some of these tools are very easily available, and for this, even on Google you'll find the answers. But otherwise, there are fact sheets and there are so many websites that give you this data handy. So for someone who's managing this and wants to use a yardstick or a benchmark or a system, the first is to ensure that you're using the right benchmark. The second is to ensure that in the peer group you're at least in the top or the second quartile.
Okay, we take that point. Santosh and Sandipan, thank you so much for joining in today. These things sound very basic, but when you take care of basics, the other things take care of themselves. So it's very important to understand these metrics and the difference between direct and regular funds as well. Thank you for explaining that so well to our viewers as well. Okay, all right. With that, we'll take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.